So just now you talked about venture capitalists, right? Venture capital and its ecosystem. So Abubakar, with an understanding of these initial options, let's talk about it. When might VC funding be a good fit for a startup, and what are some key things to know about this path?
The most important thing is, and a lot of people don't understand it, VC funding is never good for a startup. It's never, ever, ever good for a startup. You want to get VC funding when you want to scale. So, or in our context, we call them scale ups, right? These are businesses with clear clients, with huge, either if it's a B2B business, you have like really huge clients, or if it's a B2C customers, you have constant revenue, good, strong revenues, okay, strong profitability. Like that is when you want to look into VC funding. You never look for VC funding for a startup. You look for VC funding for a scale up.
Yeah, we got it. So are there any types of investments rounds in the VC ecosystem? Like, as you said that VCs will never invest in that initial startups, like initial rounds.
Mostly, right? So what we look at is like a couple of things. We look at something called a pre-seed round, like a typical startup, right? The pre-seed round is where you want to look for your friends and family money. All right. Then there is the seed stage. The seed stage is where you look for like a crowdfunding, or like if you're taking a loan, or you look at like a accelerator, incubator, all these sort of things. After seed is where you typically have seed rounds, right? Seed rounds is where you want to look for seed A. You typically, some people go into VC, but I would strongly advise against it, right? Like seed is where you look at like angel investors. And then Series B, Series E is all where you go into VC financing. These criterias, right? Like from a pre-seed to seed to Series A, Series B, Series C, these all depends from companies to companies. There is no set standard, right? If you are a restaurant, you don't even have series, right? You just have some seed and then you have money to scale up. That's it, right? It's not that complex in terms of, at least in terms of financing. But when you're looking at a tech startup, it's a little different. You have different rounds and everything. Now, even in tech startups, you have like a B2B business and a B2C business. The distance between a seed round and a Series A round varies by a large degree. Okay, so you will never really know, and there is no set criteria for it. A good criteria, at least in my mind, is where what we call in economics is an equilibrium stage or like a stagnant stage. What that means is like you built a product, you're getting 1,000 customers. Let's say, for an example, you're getting 1,000 customers in a month. Okay, can't cross that 1,000. You can't get the 1,001st customer. Okay, to get the 1,001st customer, you need to invest money to build, to improve the quality or the capacity of that business, right? To get the 1,001st customer. That is what the difference between where you need to raise the next round, right? So if you're getting 1,000 and 1,000 and 1,000 for 1 year, it's fine. For 2 years, it's fine. You don't want to get just 1,000 customers for 3 years. You want to grow, right? So the money you need to grow is when you look at VCs. So from business to business, for an e-commerce business, this might be 100,000 customers, 200,000 customers. For a B2B business, it might be 5 clients, 10 clients, 20 clients, 100 clients. Again, it depends from businesses to businesses. There's no one size fits all.
Okay, you talked about series, right? Series A and all that. How many seed rounds are there in total?
Typically, the concept is like, what do you think about this? Think about it like a plant, right? Your seed is like you are buying a seed from a guy, like from the store, right? Your seed is basically you're planting that in the soil. All right. So you can only seed once, logically speaking. All right. Then comes your series rounds. So series rounds can be almost indefinite. Typically, companies go to at least Series A, Series B, Series A, and Series B. But there are companies like there is this company in India, like a grocery delivering application. I can't quite remember their name. Um,
Is that Zepto or Blink?
I Yes, Zepto, right? So Zepto, what they are in Series E or Series F. So these again depend from businesses to businesses. There is unlimited amount of series. The idea is that when you start a business, you typically have something called a time frame. You want to exit the business within 5 to 7 years, or every investor wants to exit the business in 5 to 7 years. All right. So the idea is that you exit the business in 5 to 7 years. So what does an exit mean? Basically, you go and list your company in in Bombay Stock Exchange, right? That is an exit. Or you sell your company to somebody, like your closest competitor, or an acquisition. It's an exit. Or in large cases, in very developed economies like the US, what happens is there are firms called private equity firms. They buy the businesses and they do whatever they want. That is an exit, right? So within 5 to 7 years of you starting it, you need to exit. You have to exit. Your investors will want to exit. So that is where, so companies, Tepto, if they started in what, 2020? This is 2024. They have like next 2 to 3 years, you will see them either listed in Bombay Stock Exchange or they would have sold to a competitor.
Okay. So
Right? So that is what the tagline typically is.
so let's say I'm in a VC firm, okay? I have a startup
Mhm.
and I got some sort of like investments, not even investment, revenue. I have generated some sort of revenue and I'm in a good stage. And I'm in the venture capital right now. And I want to know, what do the investors usually look for in a founder?
Okay, so let's take it from 2 steps, okay? The first step, let's say you're a startup, like a new startup, and you are not looking for a VC, you're looking for an investor in general, all right? At a very early stage, what we look at is typically who the founders are, right? If the founders are capable, are the founders from the good backgrounds? Do they have the necessary skills? Are there any conflicts between the founders? Are there any conflicts of interest between the founders? These are all things that we typically do something called due diligence to find out. The next thing you immediately look at is the potential of the business. What is the available market? How much market can you obtain and how did you obtain that data? Right? What is the potential of the business is very important. And what is the business itself? Like, is it logistically correct? Or is there like something weird going on? Is there like a scheme going on? These are all things that we typically look for at the very, 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 very early stage business. Once business has grown, all we do the same exact thing, but we also look at revenues. We also look at profitability. All right. A lot of the companies raise money. Here's the reason why companies raise money, because they're losing money. They're not making enough profit. They're making barely any profit or zero profit. All right. They're making losses year on year. That's why they need money to cover it up. Correct. So when we do that, like when we look at like a more mature company, a scale up, for example, we look at what is their revenue and how much money are they burning per year, right? How much money are they burning? Is there any place where they're burning that is not necessary? Or are they doing some sort of a financial fraud with it? Sometimes, they do all these loopholes with shell companies and everything to pay themselves more money from investors, which is something investors typically like to avoid for obvious reasons. So we look at the revenues and what are the expenses, and does the expenses make sense in a business context? Let's say you are a restaurant, or not even a restaurant. Let's say you're Zepto. Zepto is a good example because that's on the top of my head. Let's say you're Zepto, but every year every month you're seeing that there is a 500 crore expense on restaurants. And you have to think, do you, one, how does this make sense for the business? And second, you'll think like, even if you're going for business meetings and everything, do you really need 500 crore for that? Right? So you do all the analysis and see whether this company is for real, is what they're doing legit, and is their concern correct, right, for raising money? Is their thesis correct for raising money? Are they raising money for the right reason or the wrong reason, or are they trying to defraud us? These are typically things that we have to look at. And especially for tech companies, what we have to look at is the logistics of the tech. Because there are a lot of people who don't know anything about technology, and they come and say like, oh, we are doing AI this and blockchain that and crypto this and facial recognition that and a metaverse this. They'll throw all the keywords in. When they throw all the keywords in, if you're familiar, yes, if you're not familiar with these technologies and the applications of these technologies and the limitations of the tech and how this can be abused, how this can be misused, if you don't know all of these things, you're completely screwed as an investor. So we want to try and avoid. So we do something called technical due diligence to make sure that what they're pitching is first possible, what they're pitching is the right thing to do. Just because a good example is that, let's again take Zepto. That Zepto really need AI. Okay? That Zepto really need to incorporate blockchain. That Zepto really need to incorporate the metaverse. That Zepto really need to incorporate cryptocurrency. Right? So we do all these things. If you incorporate this, what is the benefit of it? What is the disadvantage of it? If it doesn't make sense, it doesn't make sense. As simple as that.
Here in India, we have a TV show called Shark Tank, which is very popular. And sometimes the investors say that they don't like the product which a founder is selling, but they still invest just because they like the founder or his presentation or pitch. Do we have something like that in reality in VC firm? Like believing the founder's mindset and his vision regardless of what he's selling?
Look, one is that there are few investors like that, obviously, right? There are everywhere. Like investors are, it depends on people. There are also people at the end of the day. Sometimes they find certain things that appeal to them and they invest in it, but sometimes it fails, sometimes it succeeds. You have to understand that the real life is not like Shark Tank. All right? Real life is not like Shark Tank, and even Shark Tank is not real life. Like in reality, when the founders are pitching and everything, it's a much longer conversation. What they show you in Shark Tank is like 10, 15 minutes of it. But in reality, it's significantly longer. Like there is a lot more discussion going on. There's a lot more planning going on. There's a lot more thinking going on. Right? But what they do for TV, they cut it and make it dramatic, add music and make it all exciting, because you have to understand Shark Tank is not about, Shark Tank is not for business, right? Shark Tank is not for entrepreneurs. Shark Tank is not for people who are like coming up with business ideas. Shark Tank is for really, really, really stupid and dumb television audience, right? People who will like eat whatever. These are the people who will see a TV serial right after Shark Tank and enjoy both of them equally. Everything's serialized, right? Like it's serialized in nature. If you really, I'll tell you what, right? In reality, business pitches are boring as hell, right? I've been to business pitches like 1 hour, 2 hour, 3 hours business pitches like okay, think about this, right? There was this one event where it was an accelerator event, okay? We were there and we were looking at it, and I was there for 2.5 hours, okay? 2.5 hours, every team gets 10 minutes to present their business idea, and it just keeps on going. 10 minutes includes 7 minutes of presentation, 3 minutes of question from the judges. All right? This went on for 2.5 hours. By the end of the first hour, I swear to God, I wanted to put a bullet in my head. Like, that's how boring it is. Okay? Now, think about these guys, right? Like, the sharks in the Shark Tank. These guys are listening to all these things. You think people back in your home or at home watching television can stand that for 2.5 hours? Absolutely not. Right? So what TV producers do is they cut it out, add the dramatic music, dun 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 dun, all this fancy music just to dramatize it so that it can, the objective of Shark Tank is not to invest in startups. The objective of Shark Tank is to entertain a large amount of audience because that makes them more money than the investments.
Maybe just to promote entrepreneurship, they do.
Not even promote entrepreneurship. So Shark Tank originated in where? US, right? So you will see people like Mark Cuban and all these people. Mark Cuban, if Mark Cuban wasn't on Shark Tank, nobody would have known him. He would just be another billionaire, right? He would just be one of those billionaires that you randomly come across on like a Wikipedia search or when they do something. Or maybe you would know Mark Cuban a little bit if you follow NBA because he owned a basketball team, right? So, but apart from that, you wouldn't have heard of Mark Cuban. But you know Mark Cuban as soon as I say Mark Cuban because he was on Shark Tank. That's significantly more for his value, like his personal branding. But that's more for his personal branding than for entrepreneurship. Mark Cuban's not there to invest and make money because Mark Cuban already has a lot of money. What Mark Cuban wants is publicity. What Mark Cuban wants is something called earned media, right? Mark Cuban doesn't want to pay marketing expenses to bring his name out to the world. Mark Cuban wants to show up to these shows, make a few investments here and there, most of which will fail. He will make a few, but you now know who Mark Cuban is, right? So in Shark Tank, nobody's in it to help the entrepreneurs. Nobody's in it to help increase entrepreneurship. Nobody's here to make sure that businesses succeed. The judges are there. The sharks are there to improve their personal branding. The network is there to provide a new product to entertain mass audiences. That's it. Right? So it's a very flawed and, it's a terrible system, but yeah, it is what it is. It's just entertainment. These networks make more money on that than the investment. People like Mark Cuban make significantly more money with his name than on like a few $100,000, 200,000, 300,000, $1 million here and there. Right? For Mark Cuban, $1 million is like nothing. Like pennies. Right? It doesn't matter to him. For him, the earned media is worth significantly more than the amount he invests.
Okay, let's forget about all these Shark Tank and let's get back to VC. Let's say we got the involvement of VC in our business. What will be the advantages and challenges in our business, including expectation?
Can you repeat the question?
Like, what are the advantages of the VC involvement in our business, and what are the challenges businesses face?
Okay, so when it comes to VCs, the only advantage you have is you get money. Okay, every step of the way, it's a disadvantage. All right, typically what happens is the VCs don't really understand the business. They are typically unaligned with the business. Because they are in it for a very short term, right? VCs put money, they want more money in return. They don't care what happens, they just want more money in return, right? And sometimes this can be such a pain. I've personally been in meetings where like I go and say like I report to my boss saying that they are doing this, basically snitch on them, right? And that is not like, if you are a founder, that is somebody you don't want around you as much as possible. Like for me, when I was doing a job, I had the obligation to tell my boss what was happening, right? But feel good about it? Not really, because I was always like sniffing my nose around finding ways to cut costs, finding ways to see if this is going to work or not, just finding wrong things. My entire job was just finding what is wrong. And that's not a good thing to have around you. So anytime an institutional investor like an angel or a VC is involved, it's almost always bad unless you have such a strong product and such a strong vision and such a strong personality that you can avoid and deter from it. Unless you have all those things, this is going to be such a pain. You're looking at money, but what's more important than money while running a business is peace of mind. And when you have a VC around, there is... And I'm sorry for swearing.
Okay. So do you think VC control the businesses just because they invest tiny percentage of like money?
Most of the time, VCs don't give you equity for money for like 5% or 10%. They would want a significant chunk. Correct? So if you are two founders, you might start the company with 50-50. Okay. This VC will come and ask you for 35. Let's take a simpler number. Okay. Let's say he is asking for 40%. VC is asking for 40%. That means you have 60 left. So you get 30, the other person get 30. So in reality, what is happening is you started the business, you both started the business, and what happens is that VC has more equity in the business.
Equity, yes, exactly.
Right? So whenever you're making a decision, a significant financial decision, what happens is that you and your co-founder have to agree every time. Otherwise, if one of you is with the VC wins every decision. Right? So it's not like it's a control and like a puppet kind of a analogy. It's a little more nuanced than that. But regardless, it becomes like what do you say? It is an unnecessary headache, right? Yes, the money is important, but you have to understand just because the money is nice doesn't justify the complications that it comes with.